Hi, I'm Megan Horniman, and this is the Quarterly Review and Outlook. Yes, the first quarter of this year was very challenging for investors, but it didn't start that way. When we started the year, we were looking at the best labor market we've seen since the late 1960s. We had business confidence, consumer confidence. These things were running near record highs. We finally had global manufacturing expanding again. And most importantly, we had some thawing in the trade war between the US and China. So most investors and portfolio managers were positioned for an ongoing economic expansion. But we got blindsided by the coronavirus, and we saw risky assets across the world fall dramatically. In fact, if you look at the S&P 500, it saw its fastest move into bear market territory than we've seen in US history. Let's get this question out of the way. Is this a depression or is this a recession? This is not the Great Depression. This is a forced economic recession. Now you're going to see some depression-like numbers. We're starting to see that already when we look at data out of the manufacturing sector or data in the labor market. These look like depression-type numbers. But when you have an economy that was running on all cylinders and you tell it to stop instantly, it's not surprising that you're going to see steep drop-offs in some of this economic data. But what's different between now and the Great Depression is that we came into this crisis on very solid footing. That was not the case in the Great Depression. Policy error was a big part of the Great Depression. We actually have very accommodative monetary policy, and the Depression lasted a decade. That's not what we're forecasting here. Also, keep in mind, there is a solution to this forced economic recession, and that's a vaccine. The federal government has come out with a very aggressive stimulus package, and the speed at which they have put forth this fiscal stimulus is very impressive. If you look back in the Great Recession, it took them over 500 days to come up with $2 trillion for fiscal stimulus. This Congress has done it in 75. And this number is growing. We're now at $2.5 trillion. And they have made it very clear that they will continue to put forth fiscal stimulus packages as needed in order to bridge the gap between now and when the economy can reopen. This is a very difficult question to answer, and the states are in a very challenging position when it comes to reopening their economies. We do know there's guidelines in place. We know that we need more testing. We know that we need the cases to come down, but we also know that the American people want to get back to work. They're very eager to get back to work. So we will open this economy on a gradual manner. We can look internationally to try and get a timeline. And for example, if you look at Italy, we're following pretty close to about 3 weeks behind Italy. They've started to gradually reopen. If you look at China, they saw a very, very steep contraction in their manufacturing sector, but then a very sharp recovery once they started to reopen their economy. So while this is a difficult question to answer, we're encouraged by some of the data that we're seeing internationally, and we believe that we can follow along that same path, and this will be a gradual reopening of the economy. The Fed got involved in the bond market because they had to. When we shut the economy down in an instant, you started to see a fear of widespread corporate defaults. And you had a lot more sellers in the bond market than you did buyers. So the Fed had to come in as a buyer of last resort. Now, what that also did was present some opportunity, because the Federal Reserve did take some unprecedented measures where they committed to buying a lot of different fixed income assets on their balance sheet. That includes corporate bonds, high yield bonds, municipal bonds. These are things they never wanted to put on their balance sheet, but they committed to buying these. So there was opportunity when in the middle of a lot of this dislocation. There was opportunity to buy some of those investments that have been so expensive to us in the past and got very cheap to us during that dislocation, and more specifically, offered a good risk reward for our clients. Yes, we're in a bear market, which is defined as a decline of 20% or more in a stock market. But bear markets are actually pretty normal in a long-term investment cycle. What's abnormal is having a 10+ year uninterrupted bull market like the one we just came out of. And this bear market is what we call an event-driven bear market. This isn't driven by a prolonged period of declining earnings or declining economic growth. This is an event. And if you go back in history and look at other periods where we saw event-driven bear markets, they presented good opportunities into the equity market. Now, where we'd like to be positioned, if you look at international equities still are cheap in comparison to the US equity market. But in the US equity market, what this bear market did, it made some investments that we've wanted to invest in but have been so historically expensive to us, we now have the opportunity to invest in. So we've been gradually adding into the US equity market throughout this bear market. The one thing that's very important, though, is that when you are in an environment where fundamentals are very unclear, earnings growth is very unclear, it's that the appropriate due diligence and the right active managers are very important for long-term investment success. Alternative investments are meant to offer diversification for clients, and in the first quarter, they fell alongside with most of the other risky assets. We saw hedge funds struggle, had a very difficult quarter, and that was because hedge fund managers weren't positioned like we were going to have a pandemic. They were positioned for an ongoing economic expansion. Commodities, they struggled with the fact that when you stop economic activity on a dime, there is a supply-demand situation where demand falls off and supply becomes an issue. And you throw on top of that Russia and OPEC decided to start a price war, which drove the price of commodities, or the price of energy, much lower. This dragged on the commodity sector. Alternatives as a whole still have a good spot in the portfolio. We still think offer diversification and a good risk-adjusted return. Private equity is really where we like to focus on. The private space is not subject to the type of volatile swings you see in the public market. And when you have big dislocations in certain areas of the bond market, in credit, when you have dislocations in real estate markets, this actually offers good opportunities for private equity managers to make acquisitions. The bottom line is this: we will come out of this. The economy will reopen. The American spirit is very strong, very resilient, and we've been through worse in the past and come out stronger. And what we've seen is that Americans are very eager to get back to work, to rebuild this economy. And this isn't just the Americans. This is a global effort. This is a global enemy, and we have more resources being used from the biological standpoint of this to fight this virus, and we will come through this. Now, from an investment standpoint, it's dangerous, though, at this time to let the fear override your long-term discipline. You don't want to lock in losses right now. That would be a dangerous mistake. Instead, we'll continue to look at all of our asset allocation. We'll continue to try and find value in the markets where people are not necessarily looking for it. And we'll continue to make changes to your asset allocation as we see fit that fits into your long-term investment objectives. With that being said, if you have any questions at all, please feel free to reach out to any one of our financial advisors. Thank you very much, and please be safe and be well.